Hi, this is P.R. Sundar. Welcome to this special episode. I'm going to talk about one of my best investment in last 1 year. Last year, around Deepavali time, I invested in some stocks. Actually, I invested a very small money. I think it's about 7,000 or 8,000 rupees, just to show to the people how to construct a good portfolio without high risk. And I also did a video about it. So if you have not seen that video, you may look at that video here. And that time, the Nifty was trading around 18,000. But unfortunately, for the last 1 year, the markets has been in a roller coaster mode and correction mode. And from that time, the Nifty has already corrected about 5-6%. What happened to my portfolio? My portfolio has not been doing really very well, but at least it's not bad. I've beaten the Nifty. Before showing to that, so let me tell you something else. In fact, this video is all about what went wrong in my investment. First thing is that, if you look at the markets, this video is being shot on 24th of September. On 23rd of September, just one day before, US markets, Germany, France, Hong Kong, all these markets hit a fresh 52-week low. The markets are really looking very bad. Last 1 year, two main black swan events, we can say. One is this Russian-Ukraine war, and which is still continuing. And another one is the US inflation problem. It's a very big problem. Because of that, markets, down. Now, let me tell you the basis of portfolio construction. And normally, the people who do not want to take high risk, they don't put 100% in equity. They'll put some money in equity and some money in some debt or some gold related things. So what is the logic? The logic is very simple. When economy is facing some problem, markets will crash. When the markets crashes, that means economy is bad. When the economy is bad, the central banks all over the world will start reducing the interest rate to stimulate the growth. When the interest rates are being reduced, so the bonds will rally. The bond yield will come down, but bond prices will go up. Historically, for the last many decades, that is what has been happening. If markets crashes, the bonds will rise. So bonds and stock markets are inversely proportional. If stock market is very good, bonds will fall, and stock market crashes, bonds will go up. So that is why the people put some money in equity, some money in bonds. But what has happened this time? It was totally unusual, exactly opposite. US markets, US economy is too good. And because economy is too good, unemployment is very low. During coronavirus period, the government of US printed a lot of money and gave it to the people. So the people have a lot of money with them, flush with the money, and they demand high salary for working. So if they get high salary, they get even more money. So since they have more money, they are just spending like anything. And because they spend like anything, the prices, inflation shoots up. And can you imagine the US inflation is much higher than Indian inflation? And because of that, inflation getting out of control, so central banks started increasing the interest rate all over the world. And remember, when the economy is bad, they will do it. But now when the economy is good, they have done it. So because the interest rates is rising, the markets are crashing, hoping that, economy will calm down. So we are having an unusual situation where both stock markets as well as the bond prices, both are crashing. So this is one unusual thing that has happened in the last many decades. The second thing, when the economy is bad, central banks will reduce the interest rate. When they reduce the interest rate, people don't want to put the money in bank FD, because the interest rates are very low. If they get 0.25%, 0.5% return from bank FD, people start thinking, why should I put so much money for such a small thing, small return? If I buy a gold, at least it will appreciate 2-3%, So with that logic, the people will move the money to gold. But this time what has happened, the things are going opposite. Stock markets are crashing, but bonds are rising. Because the bonds are rising, the gold prices are not rising. Gold prices is also coming down. And in fact, every time in the past history, as and when there is some war in any country, the gold prices will shoot up. Why? I tell you. Let us say tomorrow there is going to be a war. There is a sign of war in India. So what happens, when the war comes, the government will have to spend a lot of money for war. So our currency will depreciate. So when the currency depreciates, so the value of money that you are holding will go down. So at that time, what people will do, the people will convert the money into gold. The gold is always traded in US dollar price. So if the currency depreciates, the gold will give you the better advantage. Historically, all over the world, as and when there was a war, the gold prices will go up. But what has happened this time, Russia-Ukraine war came, but the gold prices did not go up. And people, instead of moving the money to gold, and people started moving money to cryptos. There are some stable coins like USDT, where the value will always be pegged against the US dollar. So gold also trades in US dollar, and this USDT also trades in US dollar. So no difference. And moreover, that USDT, you put it in fixed deposit, some companies are paying 10%, 12%, 15% interest. And of course, that comes with a risk. So that risk is always there, but at least, people who are willing to take risk, they move the money to cryptos instead of gold. At some point of time, when the Russia-Ukraine war broke out, there was a news report that said the maximum amount of money that has come to crypto is from Ukraine. And not only that, there's another report that said a large amount of money has been moved to crypto from two troubled nations. One is Russia, the other one is Pakistan. Cryptos is being viewed as an alternate to gold. In fact, if you can remember, sometime during the coronavirus period, the Bank of America came out with a report saying that the gold prices, international gold prices, will shoot up to $3,000 per ounce. And I came out with a video that it's not going to happen. So I just even challenged, let us see who is going to win, PR Sundar or Bank of America. But see what has happened, after that, the gold has not even crossed $2,000. The reason is that, this crypto has become an alternate for gold. Because of that, what has happened, maybe you can look at my portfolio now. I've invested about 7,800 rupees, and you look at that Edelweiss Bharat bond, which has just given 2% return in last 1 year. And Nippon India Junior Bs has given 1.6% return. Bank Bs given about 0.82% return. Embassy Park REIT has given less return. And Embassy Park REIT, is related to real estate. So when the interest rate rises in the economy, real estate tend to do bad. And Nippon India Nifty Bs, it has given 2.29% less return, negative return. Logically, when Nifty gives a negative return, and Bharat bond and gold Bs should give a very, very good return, but that has not happened this time. The lesson from here is that, history may or may not repeat. A risk is a risk. So when we are investing, so we take the risk. But compared to negative return of 5 to 10% in Nifty, this 2% return is looking not that bad. And again, the things have gone wrong. Traditionally, what should happen, that has not happened. Otherwise, we would have got about 8-10% return. This is the thing. And then another important thing I would like to tell you that, what is the necessity, if you put everything in one instrument, so your reward is maybe very high, but your risk may also be very high. So when you diversify, so I have diversified. I put some equity related, some debt related, some gold related, and then some, is a sandwich. It's neither debt nor equity, so some better return. So the best performance is power grid infrastructure investment. And though it is showing only 14% return, but actual return is nearly 28%. So the reason here what they show, they are showing only the price difference. I bought around 121 rupees, now it's around 139 rupees. So they are showing 14.38%. But what they are not showing is the dividend. Power grid infrastructure investment has given almost 13 rupees dividend in the last 1 year. So if you take that 13%, 13 rupees dividend, so this return should be about 25 to 30%. In the last 1 year, Power Grid has given 25 to 30% return. But in fact, this is just, I did a portfolio for a small investors to follow. But in my personal account, I've invested a large sum of money in Power Grid infrastructure investment when they came out with IPO in 2022, 2021 April. So that time they issued for 100 rupees. When I bought it, it's already 121 rupees. That's sometime in November. But in April, they came out with 100 rupees. Now trading around 139, 140. So that's already 40% appreciation. On top of which, they've given a dividend of about 13 rupees. So that is taking a total return of more than 50% in 1.5 years. In 1.5 years, 50% plus, that's about 35% per annum. So 35% per annum is a very good return, considering, Russia-Ukraine war, US inflation data, Europe problem, So considering all the global turmoil, so this return is a very, very good return. The key learning points for today, number one, so history may or may not repeat. So we cannot, be assured of certain returns even when we diversify. So even when we diversify, you may tend to lose or you may tend not to gain much. And second one is, so always don't put everything into one basket. So put it in different baskets, some gold, some bonds, some equity and so on. But in fact, in my portfolio, I have allocated nearly 80% for equity, right? Very less for bonds. See, Bharat bond, just 15%. In that case, what happens? One goes up, one goes down, so you will get some moderate return. Your risk will be less. And number three, if you choose 7 or 8 different instruments, so, not all of them will do badly. At least 1 or 2 of them will be doing outperforming. So that will give you better overall return. So in my portfolio, though all other instruments have not been doing well, but this power grid huge outperformance, nearly 25-30% return in last 1 year. So that gives a better look. Otherwise, if not for power grid, the overall might have been negative also. These are all the small things. And then, in fact, when I started, my intention was actually to do SIP every month. But that you can see here, monthly SIP, installment due, invest now. So all this there, but I invested and then I just forgot about it. So I've never done the SIP. Had I done the SIP, the result might have been much better. Why much better? Because, when the Nifty was around 18,000, I invested. Then, during the next few months, Nifty went to 16,000, 15,200, So in SIP, if you would have accumulated at some lower level, now again market come back, would have given some better return. Always don't go for lump sum investment, go for some SIP and always diversify your money into equities, debt, gold like that. And then, so no matter how much you do, the past performance is no indication for future performance. History may or may not repeat. So I hope you learned something new in this video. I hope you enjoyed watching this video. Thank you for watching.